Hello everyone, here is Gemini AI. Welcome to the Explainer. Today we're going to dive into a really key accounting rule that, believe it or not, forces companies to be super honest about the true value of what they've got sitting in their warehouses.
So, let's get right into it. We're going to break down how, and more importantly, why businesses sometimes have to value their inventory for less than they actually paid for it. And it all comes down to a rule with a kind of clunky name, LCNRV. I mean, it sounds pretty weird, right? You'd think if a company buys something for $10, they'd say it's worth $10. But what if they have to report it's only worth $8? Well, in the world of accounting, this isn't just allowed, it's actually required. Let's figure out why on earth that would be. Okay, so picture a company's warehouse. It's just packed with products, and the hope is, of course, to sell every single one for a nice profit. But, sometimes things don't go according to plan, and that inventory just isn't worth what it used to be.
A whole bunch of things can cause this value to just plummet. An item could get damaged in the warehouse. It could become obsolete. Just think about last year's smartphone model the day a new one comes out. Or demand could just totally dry up. You're not going to sell a lot of snowblowers in July, right? And sometimes market prices just fall because of simple supply and demand. So here's the bottom line. If a company knows it can't sell an item for at least what it paid for it, pretending otherwise on its financial statements would just be, well, misleading. Accounting principles demand honesty. There's a fancy term for it, representational faithfulness, but it really just means telling it like it is. And that brings us to the solution. It's a rule called the lower of cost and net realizable value. It's a mouthful, so we just call it LCNRV for short. This is the tool accountants use to make sure inventory values are being reported honestly.
The rule itself is actually beautifully simple. You take two numbers, first, the original cost of the inventory, and second, its net realizable value. Then, the company has to report the inventory on its books at whichever of those two numbers is lower. That's it. Simple as that. So, what in the world is this net realizable value, or NRV? Well, it's not just the selling price. Think of it as the net cash you realistically expect to pocket from the sale, after you've paid for any finishing touches and all the costs of actually making the sale happen. And calculating it is really straightforward. You just start with what you think you can sell it for. From that, you subtract any money you still need to spend to get it ready for sale. And finally, you subtract any cost to actually sell it, things like shipping or a sales commission.
All right, theory is great and all, but let's make this real. We're going to walk through a practical example and see exactly how a company would calculate this in the real world.
So here's our scenario. Let's say a business has 100 units of something we'll call product A. It costs them $50 for each unit. They're hoping to sell each one for $52, but, and this is key, they still need to spend $3 per unit to finish them and another $2 per unit in selling costs. Okay, step 1. Let's calculate the net realizable value for each unit. We take that selling price of $52, subtract the $3 finishing cost, and then subtract the $2 selling cost. And that leaves us with an NRV of $47 per unit. Now for the main event, the heart of the LCNRV rule. We compare the two numbers. The original cost was $50. The NRV we just calculated is $47. Since the NRV is lower, that means the value has dropped by $3 for every single unit. So what's the total adjustment here? Well, with a $3 loss on each of the 100 units, the company has to recognize a total loss of $300. And that means reducing its inventory value by that full amount. This whole process is called a write-down.
But how does this $300 adjustment actually get recorded in the company's financial books? It's not enough to just do the math on a napkin. It has to be made official.
Accountants use something called a journal entry. They'll increase an expense account, usually cost of goods sold, by $300, and at the same time they decrease the inventory asset account by that same amount. And this isn't just theoretical. For instance, back in 2021, the company Lululemon recorded a similar write-down of about $31 million. It happens all the time.
And this one little entry actually makes some pretty big waves through the financial statements. On the income statement, having higher expenses means the company's profit for that period is lower. And over on the balance sheet, the value of the company's assets gets reduced, showing that new, more realistic value of its inventory. Now, this whole process might seem a little pessimistic, always marking things down, but it's actually rooted in a really fundamental accounting principle. And here is the key takeaway. It's all about something called the principle of prudence, or you might hear it called conservatism. And the idea is really simple. When you're uncertain about something, you should always err on the side of caution. Don't go around overstating your assets or your income because that just paints a falsely optimistic picture of the company's financial health.
So, at the end of the day, the LCNRV rule serves this incredibly critical purpose. It makes sure that the value of inventory you see on the balance sheet is actually achievable and realistic. And that creates more reliable and trustworthy financial reports for everyone who uses them, from big-time investors to the local bank lender.
This leads to a really fascinating final question. What if that snowblower suddenly becomes a hot seller because of a surprise blizzard in May? Is that $300 write-down permanent?
And the answer is, it depends. It all comes down to which accounting rules a company is following. Under what's known as International Financial Reporting Standards, or IFRS, which tons of countries use, you can actually reverse a previous write-down if the value bounces back. But, and this is a big but, you can never write it up for more than what you originally paid for it. It's a final check to keep everything grounded in reality.